right, wonderful. Well, hey, good afternoon, gang. It's a pleasure and honor to be here with Investor Inspiration and going after my good friend Hubert, who kept it real for you today. And we're going to talk more about that in just a few minutes, and it'll be great to then be able to hand off to Todd Gordon afterwards. So you're going to want to stay for that as well. So that's a good lineup, Hubert, myself, and Todd, to go ahead and get some kind of real deal training here today. So with that being said, what we're going to do is we're going to talk about a strategy that I use. I just used it to win the trading competition here a week ago Friday in Dallas. I used it multiple times this week. In fact, many of you that were here were invited to a special event this past Tuesday where I did a live trading event, and I did 3 trades there during that special event, one of which was the trading strategy we're going to share today. So, it's something I use quite often, and in fact today the only examples I'm going to show you today were out of a live trading account. So we're going to keep it real deal, so it's a nice tie-in with what you learned from Hubert, and then you'll be passed off to Todd, so to keep that going. So with that being said, just a couple things. First things first here, trading involves risk, not just reward. I want to go ahead and remind everybody that I'm not a registered financial representative, don't hold myself out to be, so whatever you learn here from people today, please run it by a registered financial representative and develop your own risk trading plan. Also, while what I'm going to show you today has no hypothetical results associated with it, I'm going to be going ahead and showing you exactly where I took trades here today, and and where trades were taken in a live account. The bottom line is, if you guys ask me a hypothetical question, well, if a week from today the sky's a little bit cloudy, but then all of a sudden a rainbow comes out, how would you trade? That's going to have certain inherent risks. And of course, you saw Hubert keep it real there when he gave a hypothetical earlier. He put a real big disclaimer up there to let you know it was hypothetical, but what I see a lot, and we've even seen a lot recently, people are putting up results and not telling you they're hypothetical, or they're putting them in real small print. So I appreciate him, of course, keeping it real. And then, of course, options, it's great. Options, there's a lot of opportunities with options. There's also a lot of risk with options. So here's a great website you can go to learn more unbiased, risk factors regarding options. And then finally, those trades that are taken, that you're going to see today were live trades in a live trading account with real money, not hypothetical results. So the big scam in this business is kind of a, hey, look at our track record kind of scam. However, if you look real close at the bottom of this super small print, they either tell you it's hypothetical results or they just don't say anything about what those results were. Okay, so please, for your own safety, never, ever, ever again take another trade with a company or educator, etc., without them certifying in writing that they are going to take trades in their live accounts, live trades with real money, and do it on the screen in front of you. I, Rob Hoffman from BecomeBetterTrader.com, can and do certify that I'm willing to do that in my live trading room with you. Okay? Yep. No, you're absolutely welcome, Gazelle, and all of you. Absolutely. So that's why it's a nice trifecta to hear from Hubert, myself, and then Todd. So with that being said, thank you. I've won a lot of trading competitions this year. Using this strategy, actually, was one of the big ones for those of you that kind of got to come to at least my domestic ones. Don't expect a lot of you came to the Italian one, but for those of you that came to Italy or so, they're great, or Canada. So we're going to talk about the exact same trades I used with them at that time. Now, if you are a day or a swing trader and you trade stocks, options, futures, or Forex, then you're in the right place. If you're a long-term investor only, this probably won't be appropriate for you. That's not going to be the focus of today's event. So if you're, open and closing within the same day, or you're holding up to 6 weeks to 2 months, this is the right place for you. Okay, and great. So this is my website, BecomeABetterTrader.com. You're welcome to go there and read more about that later. I do a lot of speaking for the financial exchanges. Recently did a bunch of filming for the CME. For those of you who get Modern Trader Magazine, earlier this year I was featured there in Modern Trader Magazine. You can read the articles there. If you missed it somehow, it just kind of shows my trading stuff, a little bit about me and what I do and stuff like that. I was also featured earlier this year in the biggest Italian trader newspaper, or Italian newspaper, in the financial section there after winning the Italian trading competition. And also, I have a great article. We're not going to talk about this strategy today, but it's called the Inventory Retracement Bar Strategy. It was written in 5 different languages, so you might want to do some research on that too, because it ties in really well with the strategy we're going to talk about today. And then also for those of you that get technical analysis, Stocks and Commodities Magazine, just a couple months ago, there was a nice 4-page article written about me there. So, and the strategies I use and stuff like that. So some good stuff for you. As we go ahead and go forward, though, what I really like to remind people of, I'm just like you. Kind of like Hubert, he's kind of a no BS guy, just a real guy, and I'm just like you. When I first started, gang, in the trading world, I was a teenager getting books from the library. This is actually one of the actual books, How to Read the Wall Street Journal. Okay, kind of embarrassing by today's standards for me to go back and look at that, but that's where I started. How to understand the words and the logic behind the market. So. And while I was doing that, I had 2 full-time and a part-time job. Okay, I was raising a son at home, and so I know what it's like to be busy, to say the least. So a lot of you tell me, "Hey, I've got a second career, or I've got multiple jobs, and I travel a lot. I'm really busy." I can empathize. I know exactly what it's like to go ahead and be busy and trying to learn to trade. This is my son. He's a United States Marine. I'm extremely proud of him. And he's finally coming home to me here in about roughly 4 or 5 months now. So I'm really excited. Can't wait till he finally comes home. He's been in for 4.5+ years. So pretty darn excited with him. And for those of you, many of you know, I finally got married here about 4 years ago. My lovely wife, Sarah. And we have this now beautiful daughter, Mackenzie. And as of 3 weeks ago, we have this beautiful little boy, Logan. So gang, you know what? Here's what I can tell you. You get older, but you can still stay really busy. So, I run an international company. I travel all over the world, speaking to retail and institutional clients, and here I am with a 3-week-old. So I know what it's like, to need a mentor, to get through the craziness in life, but I'll tell you, life just never really settles down. Okay, so I love this little photo of Logan and my beautiful daughter as well. So with that being said, though, the real reason you guys are here with me today is because I have won all these domestic and international competitions around the world, and what's nice is real money, and virtually all these except for one were on site. The live trading challenge for the Infinity Futures back in 2011, they did that remotely, but it was with everybody's live Infinity account. So the bottom line is that's what keeps it real. Like, it's shown in real terms, in real dollars, and cents, not hypothetical results. These are what those international trading competitions can look like, where they get up to 16 of us representing our countries from around the world. Kind of a big deal. And this was actually my equity curve caught last year on the screen during the one competition over in Italy. And actually, interestingly enough, that's basically what my equity curve was this year. Just opened up. It took me a little while to get the first trades off, but then opened up, just got bigger and better and better. Okay. And interestingly enough, just since we're on that topic, my equity curve for 2016 basically looks like that as well. So I'm very proud of what we've accomplished this year. So with that being said, the strategy we're going to talk about now is going to be one, interestingly enough, in 2012, it was the first year, no American before me had won that big international competition with the 16 traders. So they invited me out because I'd won a couple domestically here. And this strategy we're about to talk about here was actually one of the strategies that helped me get through the first round, and which, most of the time the Americans got blown out of, to take us from the first 16 traders down to 8 traders. So it's obviously something, going back even then, that was dear to my heart. And then as we look here, in one of the competitions here a couple of years ago, it became one of the primary trades I took during a major downturn in the market, and that helped me generate a lot of gross profits there. As you could see, it was pretty a big deal during that big sell-off. It took about 18 trades, and a lot of them involved this strategy I'm about to teach you. So with that being said, as we're about to get into the strategy, what makes this different? What makes this different is not just the toolbox of strategies, but how I'm using them. Everyone has stochastics, RSIs, MACDs, CCIs, you pick your poison there. Everybody kind of starts out with those same different things. But the biggest problems is usually they're either using them wrong, or they have the wrong settings, or they're using them the wrong way. Okay, I see a lot of books out there, that strategy I'm about to show you. they use it completely the opposite of how I use it, and so we're going to talk about that. I think that's what makes it different. So today I'm going to show you, in my opinion, the right way to use just one of these several strategies that I have. So with that being said, let's get into it. So what is this? It's a short-term stochastic pop against the prevailing trend. So when do I use this? In trending environments. So now this is going to be a stochastic spike trade that I'm using in a trending market. Most people use stochastic spikes in non-trending markets. So most of the books you're going to read are going to be when we get up above 80 and fall back down below the 20 fall back down below the 80 in a sideways market. That's where you're supposed to short a stochastic or a CCI or a like an RSI type situation. If it's down below 20, starts to come back up through 20, you're supposed to go long. Okay, it's one of the classic ways people teach that in a sideways market. I use this strategy in a trending market. Okay, so my favorite entries are close of bars that start below the 20 and spike up above the 80 in a downtrend, or start above the 80 and spike down to or below the 20 level in a downtrend, or sorry, an uptrend. So it starts above 80, falls down below 20 in an uptrend. Where's the exit? Trailing stops. Okay, I'm a big fan of trailing stops, have been now for the last several years. Years ago, I went ahead and had a really incredible run going, and I took a big loss because I wasn't trailing stops. Took perfectly good profit, could have walked away with the profit, turned it into a big loss unnecessarily. So it was a great learning opportunity for me several years ago. So since that time, we've gone ahead and used trailing stops. We're going to talk to you a little bit about that in just a little bit as I show you examples. Okay, where's the stop loss? Trades past the preset stop loss number, okay, or such as a key support resistance level like a 20-period exponential moving average. This will vary because it depends whether the initial trade is taken past the 20-period exponential moving average, especially if you're using like the default settings in stochastics, which I don't. But if you're going ahead and doing that, you're definitely going to see a lot more of those kind of type trades. So know the stop loss before the entry. We never get smarter once we get into a trade, gang. So we want to go ahead and know our exits, scale outs, stop out points in advance, okay? And remember a little key tip there for you. The best trades start from above the 80 level and fall below the 20, or start below the 20 and spike up above the 80. Okay, so watch and use in the direction of the 20-period exponential moving average. So let's talk about what all of this just meant that we just reviewed. First, I wanted to show the rules for you, give you a chance to take a snapshot of this, so that you'll have that and follow along. Okay, so here's some actual trades. I always like to start with these because they're just kind of fun. A couple years ago at the London Money Show, I was supposed to have a trading competition. My competitor did not show up, but the audience certainly did. It's like, well, so I'm sitting in front of 120 plus people, all huddled around, waiting for a trading competition. Like, well, okay, there's no trading competition to be had, gang. That's canceled. But what I'm going to just do is I'm going to do live trading with you here anyways. So one of the very first trades that I took there was this concept of the stochastic spike. So what I want you to do, I want you to focus now on this black line here. Okay, this black line that you see right here, that is a 20-period exponential moving average. Okay, and then this line down here, that is a stochastic. All right, now the what you see here is the 20 level down below and the 80 level up above. Okay, so 20 level down below, 80 level up above. All right, now, so what I ended up doing was you can see in a downtrend what I'm looking for now. So remember, this is basically taught to be a sideways market trade. And the way it's taught with the classic stochastic settings is that when it's above the 80, starts to come back down through the 80, you're supposed to short it. When it comes down below the 20 and starts scooping back up, you're supposed to go long it. All right, so basically what you're trying to do is channel trade. Now, real quickly, how many of you have found out that with channel trading, most of the time, by the time you identify the trade and you start taking channel trades, that you may make a little bit of money, but then as the market starts to widen out, starts to break out, you end up taking a bigger loss because your initial stops get hit, and then so you say, okay, that's not going to happen again, so you widen out your stops, Then that one gets hit, only to watch it go back up. Then it turns around and goes down even deeper. You're like, they got me here. They got me here. They're not going to get me again. I know as soon as I put that stop out, it's going to go right back up. And then that ends up being the one that just goes and goes and goes. So in the channel trading situation, you make a little bit of money and lose a lot of money. Does that sound familiar? How many does that sound familiar to? Okay, exactly. So with that being said, I'm not going to be focusing on this on a sideways market. What I want to do instead, I want to focus on a downtrend. So looking at a 20-period exponential moving average. Now, again, I always like to tease people and say, look, if your favorite moving average is a 19.26195 simple moving average, that's the secret one, or a 21 period, exponential moving average or simple, that's fine. Somewhere between 19 and 21 period simple and exponential. I use a 20 period exponential, and I was just teasing about the secret one. So somewhere between there. So that's what I'm looking for over the last 20 bars. I'm looking for a trend. In that process, then, I'm looking for the market to start from below the 20 level and spike up above the 80 level. So basically, in English, what I'm looking for is where a lot of retail traders jumped in, because let's be honest, as retail traders, many of us wait till we get those big red bars to finally short the market, or we wait for those big green bars before we finally go long the market, right? So what I'm looking for is where a lot of retail traders finally get short, and then the market turns around, spikes up, cleans their clocks, all right? And many of you have been in this situation. In fact, let's, if we would have another moment of honesty, since so many of you answered before, how many of you go ahead and feel like no matter what is, sure as could be, no sooner do you get stopped out, then it seems like the market goes right back your way. But you get into a trade, as soon as you get into the trade, it goes the opposite way. You get stopped out only to watch it go right back your way. Anybody feel that way? Yeah, so a lot of you. Okay, so, and I appreciate your honesty. So with that being said, what I'm trying to do is I'm trying to take that pressure off of me by waiting for the market to stop out those retail traders, use this tool to identify that process. So I'm looking to go ahead and start below the 20 level, spike up to and through the 80 level. And the real magic there is just that it's a 60 tick spread. So realistically, it could start at 0 and go up to about the 60 level technically, which is what it did basically in that event back in Paris. But what I'm looking for in an ideal world, start below the 20, spike up above the 80. And I usually want that to spike up fast. I don't want it to take 5 or 6 or 7 bars to finally kind of make its way up there, because that could actually be the signal for an actual overall reversal in the market. So I like it to be kind of like it is right here, nice and snappy, get up there pretty quick, usually within 1 to 3 bars. So what I'm looking for then is, once that happens, as that bar is coming to a close, so if I'm trading off a 2-minute bar, 5-minute bar, 15-minute bar, hourly bar, a couple of seconds before the close, I look to enter that trade. So you'll see here, we had the clock there. What I do is, let's say it's a 2-minute bar. Well, and let's just, this will be a hypothetical for a moment now. Let's say it's 12:21:55, and here we are getting a nice stochastic spike. I'm going to take that trade a couple seconds before the close of that bar, because I want to be into that trade before all the algorithms recognize the pattern and then start to drive it back down. Okay, that's why I have like my trading clock. If it's an hourly chart, well, then I'm going ahead and wait until well, here we'll call it 12:55 and 55, so 12:59 and 55 seconds. So I'm waiting for a few seconds before that bar closes, looking to enter that trade. Okay, and then the expectation is it's going to roll over from there. Let's look at another example. I had actually just got done teaching this class over in Barcelona, Spain. That class was on behalf of TradeStation at the time. And so the market had been going down, and so true to form, that's where a lot of retail traders are going to finally get in. We don't sell it up here, we don't sell it here, but finally we start watching it whoosh, 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 down. We start thinking about all the money we could have made if we'd shorted it here down to here. We say, that's not fair. The market's not going to take another dime away from me. I'm jumping in there. Well, no sooner do we jump in, then the market turns right around and spikes up. And this was a pretty healthy spike here. You're talking about roughly $400 per contract here. This is a stock index future. So what ended up happening though was I taught this strategy, and there we are. You can see it started here. We have the downtrend. There's the black line. Okay, it spiked up above. Okay, so it spiked up above, stopped out those retail traders, shook them out, only to have it go right back down again. Okay, so can everybody see those elements? You have the 20-period exponential moving average going down. We have the, we're starting below the 20 level. In fact, we're practically down by the 0 level, spiking up very close to the 90 level. So we have almost a 90 tick reversal on the stochastic here. Remember, we only really need a 60, and so this is great. All right, so with that being said, what I'm looking to do then at the close of that bar is fire off a short, and then expecting that as the algorithms start to kick in, then more people are going to jump on this and sell it back down. Now remember, two things to consider. What's your distance to the 20-period exponential moving average? If that distance is too great for your predetermined stop loss number, let's say you have a stop loss limit that says, I'm not going to risk more than $50 a trade, or I'm not going to risk more than $500 a trade, or I'm not going to risk more than $100, whatever your number is. Okay, and you see that the distance to get back to a key support or resistance level ends up superseding that, then the two choices from my perspective, either don't take a trade at all, or you go ahead and have to stick within your predetermined stop loss number. Okay, so the closer we can get it up to, like, let's say something major like a 20-period exponential moving average, the better. All right, so but that's how that works. Let's go ahead and talk about the trailing stop methodology for a moment, and then we'll get back to a lot more live trading examples. So I want you to think in terms of 50, 80, 90 price. 50, 80, 90 price. Okay, so here's how we originally look at this, all right? This is an example, one of my students in his live account modeling this. I just taught it to him during a mentoring session, and this was him modeling it right after. So what ended up happening here is this is Japanese yen. Okay, for you Forex traders there. It doesn't matter whether it's spot Forex or currency futures, it's the same thing, from the actual chart technicals. So what happened here is this trader went ahead and fired off a trade. That's where this little yellow line is. The target for this was up here. Now, key targets generally that I'll use are going to be daily, weekly, monthly pivot points, key long-term support resistance levels like 50, 100, 200-day moving averages. Okay. Also, you can use daily, use Fibonacci numbers like Fibonacci extensions, for instance, and you can also use other areas like, for instance, Hubert taught you in the last segment about clouds. You can use the cloud as a key support resistance level, okay? Todd's probably going to teach you some support resistance levels that you can use in his segment as well. So pick the ones that you like the most, and then what you're doing is this. So you take the entry. You have then so there's the entry. Then you have your target. Okay, in this case, that target's up over here. So as we get about 50% of the way to the target, then I want to start looking to trail by about 50% of profit earned. All right, so in real terms, what we're trying to do there is basically lock in 50% of the overall anticipated move. Okay, now once we go ahead and push up here to about 80% of the profit earned, we're about 80% of the way to the target, then we want to start trailing by 80% of profit earned. Why? What's more likely to happen? The market's been going up here. We get into an entry. The market is now coming up to a resistance level. What's more likely to statistically happen as we rally up here? So here we are. We're 90% of the way to the profit, the target here. So we're actually at this point at the target. So now we're trailing up 90%. What's more likely to statistically happen here? Is it just going to keep going and going and going, or is it going to go ahead and stop and reverse? Absolutely. It's far more likely to go ahead and stop and reverse. Exactly. So with that being said, and then here's what happens. If we notice that it doesn't go ahead and break through that resistance, then we just move it up to price. Okay. If it does break through that resistance, then effectively trail it 1-for-1 is the way I look at that. Okay. So my whole goal is to give something a chance to run, but if it doesn't run, I don't want to turn around and have it become a loss. There are a lot of schools a lot of schools that teach you just put a target out there, put a stop loss, and how many of you in this room have then repeatedly found yourself, you were in a trade, you were making money, in some cases really good money, getting kind of close to your target, only to have it stop and reverse and come all the way back down and become a loss? How many of you find that happening all too often? Exactly, exactly. And unfortunately, there's some big schools out there, very expensive schools, teaching that, and I find a lot of those students ultimately wind up with me. So, and I'll tell you right now, again, my largest loss in my trading career was a result several years ago of me going in and having a perfectly good profit on the board and not going ahead and trailing it. Okay, so that's why my company name is Become a Better Trader. Doesn't matter. Everybody knows about George Soros making $1 billion in a year, but everybody forgets about the $1 billion he lost, right? So we want to go ahead and keep it real, and these are lessons you have to learn along the way. And so, from my perspective, for me, trailing stop is the way to give it a chance to run, but not have it turn around and become a complete disaster on the other side, like too many people too often do. So that's my thoughts on this. Okay, so in the end, 50, 80, 90 price. 50, 80, 90 price. Okay. Now let's look at more of these examples. These are, again, more actual trade examples. First of all, you already saw the one, so now we're going to just kind of go back and just relook at those with a fresh eye. You got a downtrend in place. We start in a downtrend. That means we're looking for a overbought condition, and then the market to resume its downtrend. So we want to start down below that 20 level on the stochastic, spike up to and through the 80 level, looking to short at that point, and then looking for it to roll back down, and then you want to trail it down. Okay. Now, let's look at that other example now from Barcelona. So here's that 20-period exponential moving average again. Again, a downtrend. That means we're looking for a short-term overbought condition. And so then that means we want to start below the 20 level and go up above the 80 level. And of course, the more extreme it does it and the faster it does it, the better. And then we're looking to short into the close of that bar, looking for it to roll over and trail it until it stops us out. Okay. Now let's look at some more examples. I actually, this is, not, well, obviously it's not theory. We showed you some very public examples of me doing that. Let's continue on. Even with my private mentoring students, those people come to me for 5 days and spend 5 days with me for very long hours a day, 10, 12-hour days for 5 days. These same kind of trades. Just recently took one of those during a mentorship that we went ahead and had. So you can see there, here you'll see the Ichimoku cloud. Which is great stuff. And the 20-period exponential moving average was coming down as well. And so what happened, you can see it started below the 20 level, spiking up above the 80 level, okay? And then the shorts appear, and then we're looking for it to roll over, okay? Here is another example. Now, this one was actually taken by one of my colleagues in the room. I'm the full-time guy in my live trading room, but I do have like assistants that will come in there with me. And this was one here. This is actually what we call a half spike, which is a different type of trade, which I don't know if we'll have time to talk about here, but I actually teach that a whole course on half spikes as well. In fact, you can see several half spikes over here. So then you'll see here, got above the cloud, pull back, went ahead, so it ties in very nicely. So if you like Hubert's work, you like my work, you like Todd's work, it's a really nice combination, putting those things together. And so here we had that, and then it went ahead and took off very nicely after that. So that was a trade that John did in the live trading room there. Here's a trade that I did with the group. Okay, this is, you see the black line here, that's the 20-period exponential moving average again. You see the stochastic, and then we went in and we spiked up to the 8. So we went from the 20 level up to the 80 level, okay, right here. Now, let me ask you something here. So yes, so this one went ahead and ultimately rolled over, and if my entry was up over here on this particular trade. I don't remember where all the stops are on the different trades, but with the entry I marked, and then we see what ultimately happened, and that's what we want to see happen on these things. These things go down. Well, here's another one right over here, but this one's not marked. Do you think this one is still a stochastic spike? And for that matter, do you think this one here is a stochastic spike? What do you think, gang? This one here and this one here. Yes or no? See what you guys got. Okay. Most of you said yes. A few of you said no. Okay, the answer is absolutely it is. Now, some of you said no because it touched the 20-period exponential moving average. But if you remember actually the slide that I shared with you earlier, um, that's actually not a bad thing. In fact, you could have them potentially a stop right behind the 20-period exponential moving average. Or remember what I said was sometimes the best trades will actually take place once they've already gone above the 20-period exponential moving average. You remember that opening slide I had you guys take a picture of? Go back and look at the picture of it now, and you'll actually see where I said stop outs, that sometimes the trades are actually taken above the 20-period. So no, so as long as we still have the downtrend in place and we're coming from below 20 up above 80, then the answer is yes. Downtrend in place from below 20 up above 80 in a downtrend? The answer is yes. So why aren't these marked? I wasn't in the live trading room. Okay, so I only marked the ones there. I'm doing them live right there in front of people. You know, the proof is in the pudding. Doing it live on the screen in front of people. Okay, everybody talks about trading. Very few of us do it live in our real live accounts in front of people. In fact, just recently, the CFTC shut down. I think it was 4 or 5 different trading schools that were purporting to go out and be trading live. But they weren't. They were using simulated accounts. I certified my trading in my live trading account. My live trading room is in my live account. Okay, so you'll see a lot of these people put up these results, and they just won't say that they're not live in their live accounts, or they'll put up a real small little hypothetical disclaimer. So get your educator, gang, get your mentor to certify they're trading their live trading accounts. Okay. So and get that in writing. All right. So I'm certainly willing to put that in writing. In fact, I already did here in this webinar. So I trade in real money trading competitions around the world, so I'm not afraid to do that. So as we go ahead, we take a look here. We started at the 20 level and spiked up to and through the 80 level. Okay, so that was a trade, spiked up, and I really like to see these too. The reason why I like to see these whooshes, because here's what happens. Okay, so the market's going down initially here, goes down too fast, and so people start thinking about the trading, but they're scared because like, oh, it's already gone so far. But then they start seeing it bleed down a little bit, and they're thinking, well, maybe I should short, but every time they think about short, it comes back a little bit off the lows. Notice how a lot of these bars came back off the lows, came back off the lows, came back off the lows, came back off the lows. Well, that keeps traders, from going ahead then and getting into the trade. Well, then all of a sudden what happens is a lot of times near the end of a move, then also to get a quick whoosh down, and that gets a lot of traders then who didn't go short here, gets them to finally go into the trade short. Well, that's then when the market's set to reverse. Well, so at first it reverses up, they're losing money, but then it starts to kind of come back their way and they're losing a little less money. How many of you have ever found yourself in that situation where you're losing money, but then it starts to come back up your way a little bit, and you're like, yeah, go back up, go, and then it goes down deeper. It's like, no, and then it goes back up a little bit, yeah, go back up, and then it just totally falls out of bed, crashes, and then all of a sudden you see a small loss become a big loss, and that's when you panic out of the trade. How many of you have been in exactly that situation? Okay, thank you for your honesty. So with that being said, what I'm looking for then is I'm looking for those traders to go ahead and then be stopped out of their position. I'm looking for those traders that jumped in there on that fast movement to the downside after they couldn't take it anymore. I'm looking for them to be given false hope that it's going to come back their way, and then it just shoots up against their position. That's where I like to strike. Did everybody get that? Because here's 2 things that's happening. Number one, those retail traders that stopped out or that went short down below, that were given false hope that it was going to come back their way, that now they've been totally decimated. They've lost that false hope, and they saw the small loss become a big loss. And then, like in this case, you'll actually get the rebound traders, the dead cat bounce traders, thinking, oh, that's it, that's a bottom of the market, because retail traders love to be top catchers and bottom catchers. that usually doesn't end well for most of them. And so the reality is, I'm looking for those buy the bottom people to get psyched about going long and being on the wrong side of the trade. And I'm looking for the shorts who went short too far down below to get stopped out. So I love these big, whoosh bars on the back end of a move. Okay, so I'm looking then for it to come from the below the 20 level up above the 80 and looking for it to roll over. Okay, so these are all live trades, and here's one right here. So, and this will be another example of one I'll quiz you on. Here's that black 20-period exponential moving average. Here we are. We're pushing up, 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 up. The big green bars kick in. So, of course, the people who couldn't take it anymore went long, get in, only to have it whoosh back against them and stop them out, only to watch it go right back up their way. Starts from above the 80 in an uptrend, starts above the 80, falls down sharply below the 20. Right? Nice quick boom, boom, boom to the downside here. Clean the clocks of those retail traders that went long up above, and then have it spike back up here. Now, right over here, you'll go ahead and you'll notice that we went ahead and had this happen again. The question is it a viable trade? The answer is yes, it was. This happened to be a day, though. It was just before the normal time the live trade room ends in the morning, which is noon Eastern time. And so what happened was we had been sitting there for quite a while, just watching the market have paint dry at that point after the earlier trade. And so what ended up happening is like, okay, gang, looks like we'll wrap it up and stuff like that. That day, I had another event going on afterwards, so I ended up not being there to take that live trade. But otherwise, had I been there in the live trade room, I would have taken that trade because that is, still all the conditions are there. Uptrend in place, coming from above the 80, down below the 20. Okay, so hopefully you're getting the theme here, gang. And here's another way of looking at that same one. My friend Hubert was on earlier talking about the cloud, so let's go ahead and take a look at that. Same trade, just with a different view here, and because I use each of these views, and Hubert and I actually developed a joint indicator involving cloud technology. So so what happens is, here we break through the cloud, have that pullback. Okay, we're above the cloud there, and we're looking for that pullback down below. And again, here was that secondary one over here, but I didn't take that one. All right, but you see it with the cloud as well. Okay, so here's one I just did last Tuesday in the live trading room for many of you here today, perhaps. In fact, how many of you here today were in that open house that I did last Tuesday? So, since I know there's people that are on my list that were invited here today, and so if you will just kind of get a feel for how many people were there, because we did those trades. Okay, well, after this weekend, you guys should be invited, for the next one that we do. So we'll go ahead and we'll make sure you are, for those who had to miss it. But basically, what ended up happening was here, I did 3 trades total, but here's one of those trades from Tuesday. And so we had the downtrend. Can you guys all see the black line there? Can everybody see that? There's your black line. There's your downtrending 20-period exponential moving average. Now we spiked up here into that falling resistance. See how it went ahead and it came from below the 20 up above the 80 right there. Okay. That's what we're looking for. And that was a short that I did right there live in front of you guys. All right. Now, then I did 6 trades on Thursday, and interesting to note, so this is one of those things where we'd already done 5 trades earlier there, which was really awesome. So we did 5 trades earlier, and what ended up happening was we were actually in the process of wrapping up and saying goodbye. It was right around that 11 o'clock hour, and then all of a sudden what ended up happening was that secondary whoosh down had happened here, getting all those small lot retail traders trapped into the trade on the wrong side, and you had a nice positive divergence taking place over here. So there's lots of great stuff happening. So what happened was, at first it went back up, then gave the small lot traders false hope that it was going to come back down, make them money, and then all of a sudden, right there before 11 o'clock Central Time, 12 o'clock Eastern, you guys can all take a look at this on your stock index charts. This is the Russell in particular, but take a look at your stock index charts. You'll see this. The market all of a sudden went boom, 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 boom to the upside. I'm like, hey, gang, actually, wait a minute. We're not going to be leaving actually after all. Hang on. We're going to have another trade here. So sit tight. Watch me trade. I'm going to take a trade if we spike up here, and we did, and both on the 5-minute, the 15-minute chart, you can see we locked in from below the 20 level above the 80 level, below the 20 level up above the 80 level. Can everybody see that? So this is last Thursday here at noon Eastern time. You'll see that basically we locked in on the 5-minute and the 15-minute bull, so a double sell signal. And we had that really nice whoosh up there, just eating all those retail traders, all right, just totally eating them alive. And you can see it here, how we had this one more lower low, and people are like, oh my gosh, I've been missing it, missing it, missing it. Now, I'd already done 5 trades that morning, so I wasn't missing it. Everybody, if you're in my live trading room, you got to watch me take those trades live. But what happened is there's a lot of people that were out there trading on their own that were missing it. So it went ahead, and it was very painful to watch it make a new low. So they finally said, I can't take it anymore, jumping in short, or the people that are like lunchtime, part-time traders that have full-time jobs, they're coming in at lunch hour and all of a sudden see this new move to the downside. Ooh, just in time to go and get in a trade, and then it turns around and spikes up against them. So that's what I'm looking for. I'm looking for all those retail traders to get hurt. I'm looking for those retail traders to go ahead and think that they're catching a bottom. This is many of you in the room today, gang. So I'm trying to get you to think more like the hunter versus the hunted going forward, okay? And I'm sure some of you are probably wondering, so that was my final short that I did for the day in the live trading room, which was great, wonderful. Trade resolved itself. And if you go back and look, you'll probably see what happened later in the session. We went ahead and actually dropped even much lower. By the way, anybody see some additional stochastic spike trades there? Check those out. Below the 20, above the 80. Below the 20, just below the 80, but it's so far below the 20, it was down there around the 5 or 10 level. It more than met the obligation to get up 60 ticks or higher. So both on the 5-minute and the 15-minute chart, there was additional ones later in the session, okay? So, but the only ones I'm focusing on are the ones I did live in front of my students, because that's all that counts, not the theoretical stuff, okay? So with that being said, gang, those trades were live in an actual trade, you know, in the actual trade taken section there, those were live trades, okay, in a live trading account with real money, not hypothetical results. Again, I'm seeing it all over the place. You guys are seeing it. Replay your favorite videos of these people that are teaching you these days. They show you a track record. They don't say that they're doing it live in their live account. They're just saying, oh, check out our track record. And then you either got to look for the really small print that says it's hypothetical, or they just don't tell you anything. So you notice, like in Hubert's section, he went ahead and actually said, hey, look, I'm going to show you some back-tested results, and put up a big disclaimer to let you know those were back-tested. So he had the integrity to do that, okay? I have the integrity to certify my trades as live, you know, in my live account when I'm doing them live there. So you really got to watch out for that because it's just getting worse and worse. The government regulatory agencies are starting to realize it too, that more and more of these people are doing this. I said just in the last couple of weeks, they shut down 4 or 5 schools for claiming they were trading live when they were on simulators. So please, for your own safety, never, ever, ever again take another trade with a company, educator, or so-called mentor without them certifying in writing that they are going to take live trades in their live account with real money and do it on the screen in front of you. That's my challenge and my hope for all of you. I, Rob Hoffman, you know, from Become a Better Trader, can and do. And I've won those trading competitions around the world to try to help, you know, people feel some sense of confidence that there is an opportunity to be mentored by somebody who is trading live. Okay. With that being said, what I have for you today here is a great offer for virtually nothing. I'm calling it basically an ethical bribe, because what I'm basically doing, I'm giving you this strategy that you learned about here in the last 45 minutes or so, what we're doing is I've got a 3.5 hour extended version of this, which covers half spikes, full spikes, so more conservative, more aggressive entries here. And I think I just heard a microphone click in there. Somebody needs me for something, let me know. I know we're about 15 minutes ahead of schedule because we started a little bit early after Hubert. So so what we're doing here is it's a 3-part video series. Covers the entries, exits, profit stop management, and settings for my specific stochastic indicator. So all of you, if you have like TradeStation, NinjaTrader, TOS, Sierra Charts, Infinity Charts, all those different platforms, any of the platforms you can program in your own stochastic settings for. The normal settings that come with most stochastics is like 14.3.3, stuff like that, and we need to modify those to my settings. So as long as your stochastic's allowed to be, put in different settings, this will work for you. And so what it comes with is one conservative, one aggressive trade strategy, the setups, entries, exit stops, and profit management techniques for that. So you can find precise award-winning type strategies that I'm using to fit your personal trading style and trading plan. It's for part-time and swing traders, so it's intraday and end-of-day entry opportunities. Use the same strategies on daily and weekly charts as well. It's the same concept. So the full-time traders can find a lot more trading opportunities, and even the part-time swing and options traders can easily set up the trades with this methodology as well. It gives you instant access to the class. You can watch it this afternoon after you get done watching my good buddy Todd here afterwards. Or if you got Hubert's course, you can watch Hubert's course, and you watch mine, then you watch Todd's. Gives you instant access, gives you a custom stochastic indicator setting, gives you ideas and strategies I don't normally share with the public, so you'd be ready for the rest of the finale of 2016. I've been trading like a madman in my trading room, and it's just going to get better with next week FOMC, then the election, a lot of great stuff. There's 3 different sections to this course, so there's no proprietary indicators required for the main parts for the first and the third section. First and third section are basically just teaching you all of this with my stochastic settings and the 20-period exponential moving average. Okay. Then there's a midsection for those of you that are more familiar with my work, they have some of my other indicators. I have a section in there for how to use those indicators with this strategy as well. So there's 3 different parts, 2 main parts there, first and third, strictly using the stochastic and the 20-period exponential moving average. And then the last one is for those of you that have some of my other advanced tools. So basically this is to help you have advantages over everybody else, just like I'm having an advantage in winning these trading competitions. So again, it's a really great opportunity for you guys to join me. Yes, I will put the telephone number in there. You can call us, and the link is there. It's becomeabettertrader.com/win.